The international credit agency Moody's downgraded the U.S.'s credit rating from its highest AAA rating to AA1. Moody's cited the growing U.S. debt, currently at about $36 trillion, and the inability of politicians on both sides to manage it. This means the U.S. does not have a perfect credit rating at any of the three major credit agencies for the first time since the invention of government credit ratings in the 1910s. S&P downgraded the U.S. in 2011 to its second highest ranking after that year's debt ceiling fight. Fitch downgraded the U.S. also to its second highest ranking in 2023 over similar concerns raised by S&P, and specifically citing the U.S.'s, quote, erosion of governance. So why does this matter? Well, a credit rating from one of these agencies signifies how likely a country is to meet its debt obligations based on the country's financial stability. Investors consider that rating when deciding to purchase a country's debt. If a country has a lower rating, it might have to pay more in interest to get a loan for investor finance projects like building new highways. While financial experts have warned that the downgrade could lead the Treasury Department to raise interest rates as a trickle-down effect from investors charging the U.S. government higher interest rates to borrow money, they also say it's unlikely for investors to stop wanting to buy the U.S.'s debt as an investment. That's because the U.S. is still considered a safe place to invest and highly unlikely to default on its loans. U.S. Treasuries, which are securities issued by the Treasury Department to finance the U.S. government, are considered the world's benchmark fixed income asset, and the U.S. dollar is still the standard currency for international banks' reserves. CBS News senior business and technology correspondent Jo Ling Kent joins us now. So, Jo Ling, what does this downgrade mean for the average person, and what could the longer-term impact be on the economy?
Lindsay, first of all, that was a fantastic explainer, and just want to build off of that and say when we see downgrades like this, it typically makes the cost of borrowing more expensive for the consumer. You're already seeing it today, and the average 30-year fixed mortgage went up to past 7%. We haven't seen that since April. We also know that home builder sentiment, for example, is at the lowest level since 2023, according to the National Association of Home Builders, their monthly index. We also know that it could have a hampering effect on the ability of the Federal Reserve to make a decision that would sit well with consumers who are looking to enter the housing market or trying to borrow a car. We heard from the Fed president of Atlanta, who said possibly only 1/4 point rate cut, given what is happening, not just with the downgrade, but also that volatility that we're seeing when it comes to tariffs.
Give a shout out to Tiffany, our producer, for the explainer. But the Federal Reserve president of Atlanta said we may only see a 1/4 point rate cut through the rest of 2025. What's his reasoning? Is that what you're hearing too?
Yeah, you know what, look, the whole situation when it comes to interest rates and the Federal Reserve is there's a lot of uncertainty in the market. And I know we talk about this a lot, but that is the reality of the situation. Between President Trump's reciprocal tariffs and then you look at the inflation situation with big indicators like the Walmart CEO coming out and saying, look, even with reduced tariff rates, we're going to have to raise prices on some items. All of that gives the Federal Reserve pause when they're looking at the broader market when it comes to what things are going to cost and maintaining a healthy labor market. And so the uncertainty going forward, not knowing if small businesses will be able to hire or maintain staff or have to do layoffs, in addition to the big businesses and what they're saying, all contributes to what the Federal Reserve will ultimately decide when it comes to its next meeting, Lindsay.
How are investors reacting?
Well, today, look, at the beginning of the day in the pre-market, we saw all three indices in the red. A lot of those losses were trimmed. We ended up having another day barely in the green, so extending that winning streak for the S&P 500. But, a lot of this credit rating news, if you will, from late Friday was already baked into the market because of those other two credit rating agencies long ago having made those calls. So this wasn't terribly surprising. What we're going to be watching for ahead is the legislation around President Trump's 2017 tax cuts. Will that legislation, which passed a House committee, become law and make those tax cuts permanent? How much will that actually cost the U.S. government, and how will that impact the markets and people's ability to save and spend money? All of that still very much up in the air as this downgrade happened on Friday night.
All right, Jo Ling Kent, thank you.
Thanks.